Hello, this is Leroy Meadows, and welcome to this session. And in this session, we're going to talk about inventory management, just-in-time, and simplified costing methods. This is chapter 20 in the book from Horngren's Cost Accounting. So let's go ahead and get started here with what we're going to cover. We're going to talk about 6 categories of costs associated with goods for sale. Then we're going to learn how to balance ordering costs with carrying costs using an economic ordering quantity decision model. Third, we're going to identify the effects of errors that can arise when using the EOQ decision model and ways to reduce conflicts between the economic ordering quantity model and models used for performance evaluation. Fourth, we're going to describe why companies are using just-in-time purchasing. Then we're going to identify and distinguish materials requirements planning, MRP systems, from a just-in-time system or a JIT system for manufacturing, because they're two opposite ends of the spectrum here. Then we're going to identify features and benefits of a just-in-time production system. We're going to talk about different ways backflush costing can simplify traditional inventory costing systems. And then we're just going to touch on understanding some of the principles of lean accounting. So let's go ahead and get started here. Now, when we're talking about inventory management, we can use that in either retail or manufacturing settings. In either setting, we do not want to have too much inventory because there are costs associated with the inventory, such as obsolescence, damaged inventory, because it's been sitting around for so long, carrying costs of inventory, a number of different things. Theft, the risk of theft is also pretty big there. So we want to manage your inventory in a rational and a manner that's as efficient as possible. So inventory management is going to include the planning, coordinating, controlling activities related to the flow of inventory into the company, through the company, and outside the company. So we're controlling in 3 key areas: the inventory that's coming into our organization, the inventory that's in our organization under our physical control, and then as the inventory flows out of our organization into our customers' hands. Now, there are a number of different types of costs associated with inventory other than the cost of actual goods purchased. And right now, we're just focusing on retail organizations. So other than buying, let's say I buy a soda from Pepsi or Coke, and I put those on the shelf in a cooler so that on a hot summer day, someone can come in, buy that bottle of Coke, go up to the register, pay for it, and enjoy that bottle of Coke. Well, there's more to the cost associated with just purchasing that inventory in that bottle of Coke from Coke itself. There are additional costs associated with it, and we're going to look at some of those costs. There are purchasing costs, there are ordering costs, there are carrying costs, stockout costs, quality costs, shrinkage costs, and we're going to talk about each one of these here in just a second. But we have a number of different costs associated with this. So it's not just the cost of purchasing that bottle of Coke, but there are other costs associated with it. So now let's take a look at purchasing costs. Purchasing costs are the costs of goods acquired from suppliers, including incoming freight costs. Usually this is the biggest cost category of goods in inventory. So this is actually the cost of that bottle of Coke that I buy from Coke to put on the shelves. Let's say I sell that bottle of Coke for $2. Well, that cost to me may be $1. So that is my purchasing cost. That's the cost of goods acquired from suppliers, including incoming freight costs. Then we have ordering costs, and these are the costs of preparing and issuing purchase orders. And let's see, receiving, inspecting items, including the orders, and matching invoices, receive, purchase orders, and delivery records so we can make our payments. This is when we're placing an order, this is the total cost of not only placing the purchase order, but as the truck driver brings that into my store and brings in all these cases of Coke from 20-ounce bottles to 2 liters to 12-pack of cans, maybe even some 6-pack of the miniature cans. Not only placing that order, but also as the trucker brings that in, I'm going to match what he has on the invoice with what he's bringing in, and then also with that delivery record to make payments. Carrying costs. These are the costs that arise while the goods are being held in inventory. These costs include the opportunity cost of investment tied up in inventory and costs associated with storage. So for Coke, in that bottle of Coke, what kind of carrying costs could I have? Well, I'm probably going to have insurance on all my products within the store, because if something happens and there's a fire or a tornado comes through or what have you, some type of damage to the store and the inventory, I want to be compensated by my insurance company. So the cost of insurance, the cost associated with storage, well, I'm going to put that in a cooler, and that cooler consumes electrical resources. So my energy bill is going to go up to keep that bottle of Coke cold, because in the summertime, who wants a warm or hot bottle of Coke? Very few people do. So I want to keep that bottle cold. Then it's going to take up floor space. Well, floor space, whether it's inside the cooler, so I now have to have a bigger cooler, which is going to consume more costs associated with cooling, or if I stack it up outside the cooler into a storage area somewhere, well, then that is tying up space that I could otherwise use to sell profitable products. So there is a cost associated with that storage. The costs include opportunity costs, and we're going to talk about opportunity costs here in just a little bit, and that's what we give up to have that extra inventory in our store. Stockout costs. What are stockout costs? So that's costs that arise when a company runs out of a particular item for which there is customer demand. So then the company must quickly act to replenish inventory to meet the demand or suffer the cost of not meeting it. In my convenience store, if I sell that bottle of Coke, and let's say the Coke delivery person comes in on Tuesday and brings in my order, and then let's say by Friday I sell out. What's going to happen? Well, customers are not going to be happy, so I may lose customers, especially if this is a repeat performance. What's going to also happen? Well, unless I get some extra inventory immediately, I'm going to lose sales. So I'm going to lose sales immediately. I may lose customers in the long run. The costs. What if Coke charges me an extra delivery trip to come out and replenish my inventory for the weekend until my normal delivery day on Tuesday? Well, so there's a lot of costs associated with running out of product. So we don't want to. And that's the trick here in a lot of retail companies, minimizing stockout costs while minimizing stockout costs and also minimizing the level of inventory as well. Then we have the cost of quality, and these costs are incurred to prevent and appraise, or the costs arising as a result of quality issues. Now recall from chapter 19, there's 4 categories of quality costs, and this you can actually see on page 750 through the top of 753. And I'm going to touch on these a little bit here. Prevention costs. These are costs incurred to prevent production of products that do not conform to specifications. So these prevention costs are any costs incurred to make sure that we don't run into spoilage, that we don't run into rework and those type of costs. We may see some prevention costs as what? Design engineering, because we want to design the engineering process so that we minimize spoilage and waste. Supplier evaluations. We want to, the cost to evaluate our suppliers is critical in the prevention process. Why? Because we want to vet out any suppliers that do not meet our criteria for delivering a quality product in a timely fashion. There's quality training, where we allow people, or we train people to detect poorly designed goods before any further costs are implemented in there. The testing of new materials. We want to make sure that the new materials that we're going to start using, are they going to hold up to do the job? Are our products going to be quality products, and are they designed to last for a long time? Well, new materials, we need to test those. Then we have the appraisal costs. And the appraisal costs are incurred to detect which individual units of production do not conform to specifications. So this, while prevention seeks to prevent spoiled units from even being prepared and being created, the appraisal costs are there to identify during production and during the production process which units are bad and which ones we need to take off the assembly line or take out of the manufacturing process. So these are costs associated with detecting which individual units of products do not conform to specifications. So product testing, quality inspection throughout the manufacturing process, those would be examples of appraisal costs. Then we have internal failure costs. And internal failure costs are the costs incurred on defective products before they are shipped to customers. So these are fully completed units or units that have been pulled from production, but before they are shipped to customers. So these are costs incurred on defective products before they are shipped to customers. Some examples of internal failure costs can be reworking bad units, spoilage, scrap. Let's say there was an issue with the machine, and the machine caused a lot of units to be a lot of units to not meet specifications. Then the cost of repairing that machine could also be an internal failure cost. And then finally, external failure costs. That's the cost of associated with defective products after they have been shipped to customers. So you have customer support, warranty repair costs, and maybe if it's a really bad situation, you might be facing liability claims. That's an example of external failure costs. And these are costs associated with once the product is out of our hands and in our customers' hands, then the costs associated with remedying those defective products are known as external failure costs. And then finally, shrinkage costs are costs that result from theft by outsiders, embezzlement by employees, misclassifications, or just simply misplacement of inventory. Shrinkage is measured by the difference between the cost of inventory recorded on the books versus the cost of inventory when physically counted. And if you remember from financial accounting, that at the end, usually on a yearly basis, whether you're in a perpetual or periodic system, you're going to do a physical count once a year, and then you're going to adjust a book for shrinkage to make the book value match what is actually on the shelves here. So, and that's what this is. Shrinkage costs are just the costs that result from theft by outsiders, embezzlement by employees, and simply misclassifications or misplacement of inventory. And the dollar amount on that shrinkage is going to be the difference between the carrying value of the inventory on the books and the cost of inventory once we physically count all the inventory in our store. and then that dollar amount is going to be associated with shrinkage costs. Now, in a retail decision, how much should a firm order of a given product? Well, in some situations, we may be able to use the economic ordering quantity system. And the economic ordering quantity is a decision model that, under a given set of assumptions, calculates the optimal quality of inventory to order. So in order to use this, though, we're going to have to know some basic assumptions. One assumption is that their simplest version assumes they're only ordering and carrying costs. So the only costs are associated with placing an order, a purchase order, and the carrying costs associated with that. Another assumption is that the same quantity is ordered at each reorder point. So we're going to every time we hit a reorder point, we're going to need to reorder the same amount. Demand, ordering costs, and carrying costs are known with certainty, as is the purchase order lead time. And the purchase order lead time is simply the time between placing an order and the time it arrives. For example, if I place an order on Monday and the order arrives on Wednesday, then my lead time is 2 days. The difference between the day I order it and the day it arrives. Purchasing costs per purchase unit are unaffected by the quantity ordered. So the costs per unit are going to be irrelevant. We're assuming no stockout occurs, and we can adjust for stockouts in a more complex model. But in our model here, the basic, simplest version is going to assume no stockouts. And then also, managers consider the cost of quality and shrinkage costs only if they affect ordering and placing purchase orders or carrying costs. Other than that, cost of quality and shrinkage, we're not going to focus on. We're not going to consider those. So here is our formula, the EOQ formula, that results in minimizing annual relevant total costs. And the formula here is designed to get the optimal order size each and every time. So that way, and let's say my economic ordering quantity optimizes that I have to order 250 units each time I reorder. Well, every time I reorder, then at 250 units, I am minimizing the total relevant ordering costs and the total relevant carrying costs for that particular item. Now, how do we read that? How do we compute this? Well, the economic ordering quantity model, or the EOQ, the economic ordering quantity, or the quantity that we're going to order each and every time, well, we're going to figure out the square root of 2 times the annual demand times the cost per purchase order divided by the carrying cost per unit. And we're going to define those just a little bit more, especially carrying costs. But 2 times the annual demand times the cost per purchase order divided by the carrying cost of 1 unit of stock for the time period, or for the year. And that's how we're going to get the optimal amount of units that we need to order each and every time. Now, as we see here in Exhibit 20-1, and you can actually see this on page, let's see, 782. And the economic ordering quantity model, and for Glare Shade Company, the illustration that's in the book, the optimal order quantity is 1,000 units. And when we look at 1,000 units, our total relevant order costs are $5,200. That's where it's minimized on this graph here. That's the bottom point on this graph here. And also, what do I notice? I notice on this graph here, at the economic ordering quantity point, or the reorder, the quantity I'm going to reorder each and every time, not only are total ordering costs or total costs minimized, but my ordering costs and my carrying costs are exactly identical. And that would be $2,600 a piece. At any point other than the EOQ, then my total costs are going to be higher. So only at the EOQ point are my total relevant costs associated with carrying costs and purchase order costs are going to be minimized. Only at this point are they minimized. Any other point that I order, my total cost will be different. My total cost will be higher. So this EOQ point is going to help me minimize overall my total relevant costs. So how do I compute that based on this information here? Well, I can take a look here and compute my annual relevant ordering costs and take the number of purchase orders per year times the cost of placing each purchase order. So how do I figure out the number of purchase orders per year? Well, I'm going to take my annual demand over here and divide that by my economic ordering quantity, or the optimal quantity here that I compute right here. This amount right here, that's my size of each order. That's my order quantity. So I'm going to take my annual demand, divide that by my ordering quantity to get the number of purchase orders per year I'm going to need to place, and then multiply that by the cost per purchase order. For annual relevant carrying costs, I'm going to take my average inventory in units, and that's going to be my quantity ordered here. And let's say for this one, 1,000 units here in this illustration here in the previous screen. Divide that by 2 times the carrying cost per unit. So my average inventory, why am I taking my optimal units and dividing that by 2 to get my average inventory? Because I thought average inventory meant you take two numbers, combine them together, and then just split that in half to get an average between the two. Well, we are, because when we're managing inventory, what we're assuming here, and let me go to this point ahead of time, is that when the products arrive, when those sunglasses arrive for glare shades, I'm going to be out of inventory. So that inventory is going to be arriving just as I run out. And as I run out and I get that new order, then I go from 0 units to 1,000 units. So my average inventory is going to be the amount of inventory I have at the beginning once I receive that order, plus 0, because I'm assuming that, and I want that inventory to arrive just as I'm running out so I can minimize my costs. So that's my quantity, my economic ordering quantity divided by 2. So that's why it's just easier to just take the economic ordering quantity, divide that by 2 to get my average inventory in units, and then multiply that by my annual relevant carrying costs per unit. And then as we see here, annual relevant total costs are my annual relevant ordering costs plus my annual relevant carrying costs. Remember, these are the two costs. These are the only two costs we're considering here. And we saw down here, we only consider the cost of quality and shrinkage only to the extent that these affect ordering and carrying costs. So ordering and carrying costs are the only cost that we are paying attention to. So, and as we saw on the graph here, at the EOQ point, my annual relevant carrying costs and my annual relevant ordering costs are going to be identical. So when I have my annual relevant total costs, if each one of these is identical, if this number here is identical to this number here, then I'm at the economic ordering quantity point. I'm at the optimal point of ordering inventory. that minimizes my total relevant costs. And remember, the relevant costs are only those associated with placing orders, not the cost of the units themselves. The cost of placing the orders, the purchase orders, plus the cost of carrying each individual unit. So a second decision that managers must make, in addition to ordering, the amount to order at any given particular time, is when to order the product. So we have to look at when do we reorder the product. The reorder point is going to be the quantity level of inventory on hand that triggers a new purchase order. So once I reach down to a certain point, I'm automatically going to place a purchase order for the optimal quantity. So the reorder point is simplest to compute when we both know demand and the purchase order lead time are known with certainty. So the reorder point is going to be the number of units sold per unit of time to purchase order lead time. So if I sell, let's say I sell 100 bottles of Coke a day, and it takes me 3 days to get those bottles of Coke in from the time that I place the order to the time that Coke delivers, then I'm going to sell 100 times 3 days, and that's 100 per day, times 3 days. So I'm going to place a reorder. I'm going to place a new order when I get down to 300 bottles. Once I'm down to 300 bottles, then I know that I want to place a new purchase order, because in the time that it takes me to get that new delivery 3 days from now, I'm going to sell 100 bottles per day for each of the next 3 days. So that's how we use reorder. Let's look at another situation here. Let's say that something is, let's say that we have to order, we do a number of widgets, and let's say this part takes 2 weeks for us to get it. So times 2 weeks from our supplier. Let's say we get this widget from our supplier, and from the time we order it to the time we receive it, it's a specialty product, got to be made to order. It takes 2 weeks for them to make it and get us back here because of their production process. And let's say that I order, or I use, and that's probably very bad writing with my mouse here, I use 150 units per week, or per day. Let's use it per day. And let's say that our manufacturing process is open 5 days a week. So how many am I going to use in this 1 week? Well, I'm going to use 150 times 5 is 750. So 750 per week times 2 weeks. I would need to reorder once my inventory level got down to 1,500 units. So we want to look at converting this, making sure that the number of units per unit of time right here matches up with the lead time as it's stated. If this is in weeks, then this needs to be in weeks. If this is in days, then this needs to be in days. Okay. And as we see the ordering point, when we place an order with the Glade shares, or Glare shades rather, we see the lead time is 2 weeks before they can get their inventory. From the time they place their order to the time they receive it is going to be 2 weeks. So we see that once they place their order, once after they place their order, they have 2 weeks. They're going to run down the existing stock, and just as they run out, guess what? It's 2 weeks. My new shipment comes in, and now I'm back, and my inventory levels are replenished. And then we can go through this process again. When we get down to 500 pairs of glasses, triggers a new purchase order for 1,000 units. And then once I sell those 1,000 units in 2 weeks, bam, another order comes in. So my inventory is always replenished by that. So now let's talk about with safety stock. Now, safety stock is inventory held at all times regardless of the quantity of inventory ordered using the EOQ model. And that safety stock is going to be a buffer against unexpected increases in demand, or when there's uncertainty about lead time and unavailability of stock from suppliers. Now, managers are going to use a frequency distribution based on prior daily or weekly levels to demand to compute safety stock levels. So, we do want to carry safety stock at times because of, let's say, there may be uncertainty about lead times. Maybe there's a holiday. A lot of companies order overseas, so you have the Chinese New Year. If you're buying in your inventory being manufactured in China, well, you want to make sure you get all your inventory out now and get it out and shipped out now because they shut down for a period of time, and then you don't know when you're going to get it. So unavailability of stock from suppliers, uncertainty about lead time, unexpected increases in demand are all reasons why we might want to carry safety stock. Now let's talk about the relevant costs as categorized. Carrying costs, we're going to talk about that in just a second. Stockout cost, the cost of expediting an order from a supplier, and then also the purchase order costs, those costs that will change with the number of orders placed. So if the costs change, the more we place an order, the cost of placing an order changes, and we need to take that into consideration as well. Now, when we talk about carrying costs, inventory and carrying costs consists of relevant incremental costs, but also when we talk about the materials handling, storage costs, and so forth, but also the opportunity cost of capital. So part of our decision-making process is, if I order all this extra inventory, what am I giving up? What am I giving up if I can take that capital and redeploy it to other investments, whether through the manufacturing of a product or through short-term securities or what have you, to earn a higher rate of return? Because remember, because when we carry that inventory, it's not just the cost of purchasing the inventory, it's the cost of storage. We have to have a bigger facility, more utilities for heating, cooling, and so forth. So there's a lot to take into account, but also the opportunity cost of capital. How could I redeploy that capital to better earn additional operating income for the company? And then again, relevant incremental costs, those costs of purchasing of the purchasing firm, that will change with the quantities of inventory held. Now, when we talk about relevant opportunity cost of capital, we're talking about the return foregone by investing capital in inventory rather than elsewhere. So it's to calculate it as the required rate of return multiplied by the per unit cost of acquiring inventory, such as the purchase price of units, incoming freight, incoming inspection, and so forth. And opportunity costs are also computed on investments if these investments are affected by changes in inventory level. For example, if I have a choice to either buy a whole bunch of inventory and have it on hand ready to go so that I don't have to worry about placing as many purchase orders, so my cost of placing those orders is reduced, but I also have to consider If I'm buying all this inventory that may be cash that I cannot invest elsewhere because I have that significant increase in inventory. Now let's talk about the cost of a prediction error. When we're predicting relevant costs, it's going to be difficult and rarely is going to be flawless. So when the cost of actual relevant costs differ from the estimated relevant cost used for decision making, what is that actual cost? What if our actual costs come in different than what our estimated costs? What is the cost of that decision? So how do we compute the cost of a prediction error? Well, the first step is to compute the monetary outcome from the best action that could be taken given the actual amount of the cost input. And in this case, in the book, is the cost of placing a purchase order. And in this case, when Glare Shade assumed that their ordering costs were going to be $100 per purchase order, but let's say that it actually came in at $200. So then we need to adjust that and recompute the actual amount of costs, the total relevant costs. Then in step 2, we're going to compute the monetary outcome from the best action based on the incorrect predicted amount of the cost of input. And if we do that, step 2, we're going to go through the EOQ model again based on the incorrect assumption to calculate the new optimal quantity and calculate the total relevant total cost from there. And then step 3, take the difference between step 1 and step 2. Now, when we have the EOQ decision model and manager's performance, sometimes their goals are not going to line up. Because as we know, and as we've talked about, and as you probably experienced in the real world, sometimes people make decisions that make their own performance look best and are not in the best interest of the company. Now, we've talked about the EOQ model, and it takes into account opportunity costs because these costs are relevant costs when calculating inventory carrying costs. But if managers are not, if managers are evaluated on financial accounting numbers, as really is the case as often, using financial accounting numbers, they ignore opportunity costs. Why? Because opportunity costs are never recorded on the books. It is just something that we've given up, but the opportunity cost when we're dealing with everything in total is not recorded because it's not an actual cost. So with managers looking at making their own performance look better, we'll only focus on measures used to evaluate their performance. So you're going to have some conflicts arise between the EOQ model's optimal order quantity and the quantity that managers regard as optimal. So you're going to have two different opinions here. You're going to have one from a cost management point, EOQ, which allows the company to redeploy excess cash into other things for a return on their investment. But you also have managers that say, hey, you know what? I don't care about that. I just want to make my own performance look good. I'm looking as far as my performance review, my bonus is tied to financial accounting measures. So therefore, I'm going to go ahead and do what I want to do. So you do have some conflict there. And that's a concept we've talked about in a number of these videos here is goal congruence. Having the goals of individual managers line up with the goals of the company so that the company can have the most optimal operating income and efficiency as well. So this is Leroy Meadows. I want to thank you for joining me. We're going to continue the discussion in the next video when we deal with just-in-time and then also backflush costing and then lean accounting. So I want to thank you for joining me. Have a good day.